If you live in an Indian metro today, you don't really plan your grocery shopping anymore. You just open an app, tap a few buttons, and within 10 minutes, the order is at your door. This shift in how people shop is driving a market projected to reach $11.4 billion by 2026. At the center of this acceleration is Zepto. Founded by two teenage Stanford dropouts, Adit Palicha and Kaivalya Vora, the company has reached a $7 billion valuation and is now preparing for an 11,000 crore rupee IPO. To see the cost of that growth, look at Zepto's 2025 financials. Revenue hit 9,669 crore rupees, but in that same period, their net loss nearly tripled to 3,367 crores. This raises a high-stakes question for the entire industry. Is this heavily funded 10-minute model a permanent fixture of Indian retail, or is it an unsustainable bubble nearing its breaking point? When Zepto's founders launched their first project, Kirana Cart, they tried to deliver from traditional corner shops. But as you can see, these stores have dense, undigitized inventory. Stock levels are unpredictable, making it impossible to guarantee a strict 10-minute window. To solve that unpredictability, they pivoted to dark stores. These are micro-fulfillment centers located in urban hubs that are closed to the public and optimized entirely for digital order speed. This diagram shows the operational logic. Every dark store is restricted to a strict 1.5 to 2.5 kilometer radius. Traveling further makes the 10-minute promise physically impossible. The moment you tap order, the clock starts. Inside, a worker uses an AI-optimized tablet to follow a path through the aisles. The goal is to pick and pack the entire order in under 60 seconds. 10-minute delivery is the result of decentralized inventory and algorithmic precision. By placing products closer to the customer and automating the packing route, the system reduces fulfillment time to the absolute minimum. Maintaining that speed on a national scale has created a fierce war for market share in India's major cities. As of late 2024, Blinkit leads the space with nearly half of the market share. Zepto follows as the primary challenger at 29%, with Swiggy Instamart taking up 24%. In this model, the companies own the inventory and the warehouses. This requires massive, continuous spending on real estate and infrastructure in some of India's most expensive urban neighborhoods. This creates a significant cash burn. Between aggressive expansion and heavy discounting to attract users, these platforms are spending hundreds of crores every month. Right now, growth is prioritized over sustainability. It is a war of attrition where the players must outlast each other before their investor capital runs dry. To win this war, Zepto is working to stabilize its unit economics. Over 60% of their mature dark stores have reportedly reached operational profitability, or EBITDA positive status. The path forward involves increasing the average order value. This graphic illustrates the shift. By delivering high-margin items like electronics, beauty products, and pharmacy orders, the platform can make more profit on every delivery run. They are also adding secondary revenue streams, like the Zepto Pass subscription and Zepto Ads, which lets brands pay for premium visibility on the app. The upcoming 11,000 crore rupee Zepto IPO will be a major litmus test. A successful listing would move the model from the private world of venture capital into the scrutiny of the open market. The stakes are clear when you look at Dunzo, a pioneer in the space that recently collapsed. Their exit is a reminder of what happens when cash burn isn't balanced by operational discipline. In the coming months, the public markets will decide if the digital supermarket is a viable long-term business. If the IPO holds, the era of everything now will have established its place as a permanent part of the Indian retail landscape.